Hey everyone, this is John Carvello. I am president of Stone Oak Capital. I'm so humbled and grateful that you're able to join me here today on this webinar on business valuations 101. I think it's a super important topic that, really, I think a lot of, not many people really get past the surface level of understanding business valuations for middle market professionals. So for middle market businesses. So that's why I'm putting on this seminar. I'm super excited about this. I'm passionate that this learning is very important for business owners and professional advisors and other people that are serving this lower middle market. So I'm really grateful again that you guys can join and hopeful that you'll find value in this presentation and seminar here. So let's dig into it. I have some few slides that I want to share. Again, this is Business Valuations 101. And we're going to do this as almost like a university level course where we're going to be bouncing back and forth from a little bit of theory and then also some practical knowledge and experience that I'd like to share with you guys. So let's get into it. So before we go, I'll give you a real brief overview on Stone Oak Capital. I am the founder of Stone Oak Capital. We've been around for over 12 years now, going on 13 years. We provide M&A advisory and valuation advisory. So valuation advisory around anything having to do with the transaction, buying, selling a business, shareholder disputes where one shareholder is buying out another shareholder. So anything that involves like buying of equity will help around valuation. And then we'll also help on the execution of selling businesses and helping acquirers acquire businesses. So that's a brief introduction on Stone Oak Capital. Give you an introduction on myself. I won't spend too much time here. Really want to dig into the information, but I'm an M&A advisor, M&A professional with over 20 years of experience in this world of buying and selling businesses. I've worked on deals with over $1 billion of transaction value. I've probably worked on, I would say over 200-300 business valuations. So, I hope you feel like I know what I'm talking about in this topic of business valuations. And I'm also a passionate deal maker. So I've been an educator in the M&A space. I've built and have been fortunate to build one of the largest publications on merger and acquisitions in this middle market space. Is called Divestopedia.com. It has some pretty amazing content on it. So if you're interested on learning more, just past the business valuation information, learning more on just middle market transactions, please go to Divestopedia.com. And there's a wealth of information and content there. So let's move on to this topic of business valuations. So just to give you an overview, we're going to calculate normalized earnings in determining this business valuations. We're going to look at determining multiples and enterprise value for middle market businesses. We're going to assess what a delivered balance sheet and deal structure might be, again, in this notional context of buying and selling businesses in the middle market. And then we're going to calculate equity value. So there's a difference between enterprise value and equity value, and we're going to talk about what that difference is and walk you through it. So again, it's going to be a mix of theoretical, which will be these slides, and then we'll get into an actual case study and some Excel spreadsheets that I prepared and help you kind of walk you through it, but also let you see how I think about valuation and some of the things that I'm considering when I'm valuing a mid-sized business. And then finally, we're going to understand this concept of goodwill. Goodwill is really important. Articulating it, valuing it, putting a quantum around it is super important. And we're going to do that also in this next, 50 minutes or so. If you have any questions, please put them in the Q&A box. You could speak to me on the chat. You could speak to other participants on the chat if you'd like. The chat box is open, so if you'd like to do that, please do that. Let me just make sure that the chat box is open. Yeah, it looks like it's open. So, okay, guys. Let's get into business valuation. So the definition of business valuations is actually pretty simple. It's the present value of future cash flows. And in that definition, there are really two variables. So the first variable is cash flows. What is a sustainable level of these future cash flows? And that's something that's going to be, paramount in determining when we're looking at business valuations. And the second, of course, is the present value of the cash flow. So how do you determine present value? You have to use a discount rate or a capitalization rate. And really all that is it's the quantum of the risk around achieving those cash flows that you've determined that are sustainable in the business. So those are really the only two variables. It sounds pretty simplistic. Obviously, there's more detail to all of this, but those are the only two variables that you need to determine when you're looking at business valuations: future cash flows, and then again, how do you discount or capitalize those future cash flows to come up with the value? So let's get into this first variable of sustaining cash flows, right? The first kind of step that you need to look at is calculating EBITDA. We should all be pretty familiar with this acronym stands for right now, but for anybody that's not, the acronym is earnings before interest, taxes, depreciation, and amortization. And really, EBITDA has become a proxy for cash flow. And it's not exactly because, you're not considering the tax structure or taxes around that cash flow. You're not considering the capital structure and the amount of like capital assets that need to go with the depreciation and the amortization. And you're also not considering the interest that needs to be paid on any sort of financing within the business. So it's before those items, but it is really trying to get to a proxy of cash flow before considering the tax structure, the financing structure, and the capital structure of the business. So those are pretty big pieces that we have to consider to get to cash flow. But let's just, kind of use that metric right now because it is an industry metric for being the start of determining, the sustainable level of earnings in a business. And then the second part that you want to consider on EBITDA. So EBITDA, all of these items, the interest, the taxes, the depreciation, and the amortization should be coming directly from the income statement, right? So you're taking earnings, you're adding back those items that should be line items exactly on the income statement, and you're calculating EBITDA. And then on top of that, you'll also be normalizing for items such as things that are not recorded at fair market value in the financial statements, some one-time expenses that might be in the financial statements that aren't reoccurring. And then there are some other items. To dig a little deeper into this, I've actually written an article on, the top 10 EBITDA adjustments, and I'm going to share that with you right now. It's on Divestopedia. It's the top 10 EBITDA adjustments to make before selling a business. And, we go through these in a lot of detail in this article, and I'll actually share this in the chat box right now. I have a link to it that I'll share in the chat box. Everybody should be able to see that. And you can review this in more detail. But there are things like non-arm's length revenue and expenses, revenue and expenses from redundant assets, fair market value salaries, so salaries to owners that might not be at fair market value, so there needs to be an adjustment for that. So there are many things that might be needed to normalize that EBITDA again, to show a buyer what would be a normal level or a more consistent level of earnings that a buyer might be able to achieve in the business. So let me just get back into the presentation here. Okay, and then the next step after we've calculated EBITDA, we've determined normalizing items is, we should forecast revenue and EBITDA for the next year. We're going to be doing this for the last, say, 5 years, but then we want to look at what sustainable levels are going to be in the next year. And if you could, the year after that, right? You want to present, not only what the business has done historically, but what the business is going to do in the future. And of course, as we talked about, it's the present value of future cash flows that somebody is caring about in determining value. So the future is much more important than the past. The past is only to provide a sample size or a trend or historical empirical evidence of what the business has been able to generate. But the future is more important than the past in determining value. I'm just going to take a pause here and see if there's any questions that anybody might have. Again, please feel free to share the questions here in the Q&A box. Okay, so the last, again, is, after you've done this, you've calculated EBITDA for the last, 3, 4, 5 years. You've looked at forecasted normalized EBITDA for the next couple of years. You're going to try to assess what a sustainable level of revenue and EBITDA is going to be. There's no magic formula for doing this. It takes a lot of judgment and opinion. And there's going to be different views on this, right? A buyer is going to view it differently than a seller is going to view it. But really trying to, create this story around what a sustainable level of EBITDA or earnings or cash flow is for the business is an important piece. So let's actually dig into this right now, and let me show you some Excel schedules that I've prepared in actually looking at this. So this is an example business that I put together. We'll call it ABC Industries Inc. We have financial information, and this is coming directly from the financial statements, or should come directly from the financial statements, from the income statement. You could see this business is pretty sizable. It generated revenue of about 60 million in 2018. Grew to 88 million in 2020. It had a little bit of a dip in 2021. Let's say that's due to COVID and all that happened in COVID. Bounced back up to 88 million in 2022, and really jumped significantly in 2023, and is forecasting some more growth in 2024 here. So, and you could see that, again, net income is directly from the financial statements, and we add back these items for EBITDA. So we add back amortization, we add back interest, and we add back income taxes to get to our EBITDA before normalizations. And then what you want to do is you want to look at things that are in the financial statements that are, again, either not at fair market value or are one-time costs, right? So in this example here, the business actually had real estate within the business. So they weren't paying any rent because the real estate was in the business. They didn't have to pay rent to a third party. So we had to determine what would be fair market value rent for that business to pay if they were to rent it from a third party. So we did a determination that the fair market value rent was about 1.2 million, 1.3 million. So you have to deduct that from the EBITDA on the financial statements to get to a normalized EBITDA number. And there might be other adjustments in the business, right? You might, in a lot of businesses that I see, they might be paying the shareholders that are managers in the business a wage that's below fair market value. So you'd have to consider, okay, what do you need to pay a manager? What fair market value wage would you need to pay a manager? And you have to make that adjustment. So, you're really trying to determine, if a buyer was to buy this business, how would they run the business, and what would be their, normalized earnings that they would get from this business? Is this clear for everybody? Any questions? We have a really quiet audience today. And again, there's no, one thing that I will say, and I think this is an important point, and I think this is a good kind of takeaway for anybody that's on the call and either helping their clients through or is working in a business, that's trying to calculate normalized EBITDA. These normalizing adjustments that go through or get put on this normalizing EBITDA schedule are going to be scrutinized, right? If they're not coming directly from the financial statements, a prospective buyer or somebody that's looking at a normalized EBITDA schedule is going to look at them and really question, what, as in this example, what is the fair market value of rent, right? Is it 1.2 million? Is it 1.5 million? So you need to really get evidence, the best evidence would be third-party evidence of what is actual fair market value. If there's any sort of reports in terms of what fair market value salaries would be for a particular, role or responsibility that you're bumping up, you'd really want to get some of that evidence in place. And you also really want to make sure that all of these items are itemized on the income statement. The easier it is to, go and reference this back to income statements that have been audited or reviewed by external accountants is very, very, very good. And it's very, it makes life easier, and it gets less scrutinized by prospective buyers. If we could go to every line item and say, okay, amortization is added back, interest is added back, income taxes is added back. Fair market value rent would not be added back, because you should have a monetary transaction to pay fair market value rent, even in non-arm's length, arm's length relationships. So any way you could create, that payment at a fair market value within a company is a very good way to reduce scrutiny within, when you're entering into a transaction. I have a quick question here. How does importance of EBITDA change between assets versus share sales? Yeah, so, I don't think it changes at all, given, if you're going to sell assets versus shares. Like, EBITDA is EBITDA. It's coming directly from your income statement. And it wouldn't have any impact in terms of if you're selling assets versus shares. So again, EBITDA is, on the income statement, there's no impact on the type of sale that you might be contemplating when you're looking at selling your business. Second question, if you are normalizing rent, would you also include the investment in that real estate that led the co not to pay rent? Okay, so great question. We're going to get to that here in a second, but that is a very, very, very good question. So you're normalizing the rent, but the building is on your balance sheet, right? In this situation, the land and building is owned by the company on the balance sheet of the company. So if we're normalizing rent, then typically we would have to pull the land and building outside of the transaction. It wouldn't be included in the transaction, but we'll get to that here in a second. Very great question. Okay, let's get back. Any other questions? I'm gonna put this out there. Any other questions on like normalizing and determining EBITDA? I guess the last point I'll make on this is, you could see that the normalized EBITDA that we have here is growing for sure. It has this dip in 2021, likely because of COVID, but it's growing in the next 2 years pretty significantly, right? The margins stay relatively consistent between, can we say 4 and 6% that they're forecasting. Of course, this is forecasted. They never actually achieved this result, right? They've achieved, 2018 to 2023 is actual. It's something that they've achieved. It's recorded in their financial statements. So, if we're looking at EBITDA, again, buyers are going to scrutinize and say, well, let's take an average of the last 4 years. A seller is going to say, well, look at this. I've done $5.5 million of EBITDA, but looking to do close to $7 million of EBITDA next year. So there's no right answer to this in terms of what the right sustainable level of EBITDA is. But I typically use the most recent year as the year that we're going to apply a multiple to, and all the other years, all of this kind of up and down and fluctuation is incorporated in the discount rate or the capitalization rate, which we're going to get into right now. Okay, let me share my screen, get back to the presentation here. Okay, so the next variable that we talked about is determining valuation multiples. So there's 3 ways to determine a valuation multiple. The first is public company multiples. So public companies, they're traded. There's an implied value with their market cap, and you can calculate what the enterprise value is of publicly traded companies. And then based on their earnings or EBITDA, you can work backwards and say, okay, the company is trading, it has a 10, $100 million enterprise value. It has, $20 million of EBITDA. So the valuation, the implied valuation multiple is 5 times, right? 5 times 20 is $100 million. So you could look at publicly traded companies to determine what valuation multiples are in particular industries. You could look at comparable transaction multiples. So public companies will go out and acquire other businesses. They'll disclose, how much they paid for those other businesses, and you can imply what the valuation is on those. So that's a second way of looking at and determining valuation multiples. And then the third way is based on empirical evidence of capitalization rates. So this is looking at return to shareholders in the public markets over a number of years. And then based on those returns, you can calculate what capitalization rates are on different sizes of businesses. So, very large businesses will have certain capitalization rates, and they'll look at different sizes and segments of businesses. And through this empirical evidence, they'll say, okay, the capitalization rate or the valuation multiple on these things is, within a certain range. So those are the 3 ways of determining valuation multiples. Let's talk about the relationship between risk and value. And this is going to seem, almost like stupidly obvious. Let me just put it that way. But let's go through this, this example right now in terms of the relationship between risk and value. So I have 2 columns here: less risk, higher risk. So a company that has 100 customers will be less risky than a company that has 1 customer. A company that has many locations will be less risky than a company that has 1 location. A company that has $100 million in revenue is going to be less risky than a company that has $1 million in revenue. Same with the management team. So this is very, very obvious, but I just want to create this relationship between risk and value. So there's very obvious qualities within a business that make it less risky. And we can all identify, those things: customer concentration, size, number of locations, the depth of the management team. Those are some, but I'm sure we can, spend the next 20 minutes describing other factors that can, really qualitatively describe if a business is higher risk or less risk. So obviously, companies that are less risky, they'll be more valuable. So there's this relationship between risk and value. Less risk equals more value. And now there's this relationship between risk and return, right? And we can look at this. This is evident in the marketplace by the things that we invest in, right? So if we invest in government treasuries, the return for those government treasuries now are probably between 4 and 6%. If we're investing in corporate bonds, the return for those corporate bonds are anywhere between 7 and 9%. These are very general rates of returns. Blue chip companies, you're looking for returns of like 10 to 15%. Well-established large companies, you're looking for returns of 16 to 24%. And you can see the rest. Mid-market businesses higher, Main Street businesses higher, and startups are even higher return that you're looking for. And the reason for that is because the risk gets higher on these items. The risk around government treasuries are much lower than the risk around startups are. So you're willing to accept a lower return because there is lower risk, right? So that's the relationship between risk and return. Lower return, lower risk. Now, let's talk about the relationship between return and value, right? We did the relationship between risk and value. We did the relationship between return and risk. And now let's do the relationship between return and value. So a company, if a company that is going to give you a 10% return, right? So that would be a big blue chip company like Apple or Microsoft. You're going to pay a much higher multiple for that return because there's less risk around it. There's more certainty around the ability to earn those cash flows, right? For a business that is smaller, there's more risk around it, $100 million plus business. You're probably looking for a higher return, so you're going to pay less of a valuation multiple. Same thing for a smaller business between 5 and 50 million. You're going to pay, again, a smaller valuation multiple. And then a business that's less than 5 million, it's just a riskier business. So you're going to want a higher return and pay less of a price on that. So does everybody understand this relationship between risk, return, and value? Okay, I don't see any questions on that. So I just wanted to get this concept around your head because, it's really important when we're thinking about these businesses, especially in the middle market. Like, investors are looking for returns of 25% plus on their money. And that's why the multiples are staying at, kind of the 5, 6, 5, 3 times, 4, 3 times, right? Because there is higher risk around achieving these levels of cash flow. Okay, let's get back into our example and let's actually calculate the enterprise value for this business. So again, now that we have this concept of risk and return, there's risk in this business. It's a $100 million business, so it is pretty sizable, right? It has a good level of earnings and EBITDA, normalized EBITDA. It's doing kind of $5 million plus of EBITDA in 2023. But you look at this and it is pretty, up and down. There's definitely been variations in revenue. There's been variations in the profitability of the business. There's definitely a difference in terms of the forecast versus what they've been able to achieve in the past. So there's risk around this business, right? It's not clear cut in terms of what the sustainable level of earnings are, and consequently what the risk is. But if we're looking at getting some, kind of market evidence on what the valuation multiples for this business might be, we turn to publicly traded companies. So, this business, again, being in kind of the industrial, engineering and construction space, in the industrial maintenance space, we've gotten comparable public companies, and we look at their implied valuation multiples based on their 2022, 2023 EBITDA. So the valuation multiples for some of these businesses range anywhere from, on average, on the low end, so it would be 6 times anywhere to 10 times. So that's a pretty large range. But then we compare our company that we're trying to value. And again, they were about 100 million or so in revenue, $5 million in EBITDA. And we look at the enterprise values of these publicly traded companies, and we see the enterprise value of these publicly traded companies are in the billions, right? Some of the smaller ones are 500 million, 800 million, but a lot of these companies are $20 billion. And you could see that these big companies, the Stantec's of the world, the Jacobs Engineerings of the world, A, they're global, B, they're much, much larger. And you could see that the valuations on these businesses, 10 times, 11 times, 12 times, they're going to be a lot higher than the valuation that would be warranted for the business that we're trying to value, right? So again, there's lots of judgment. There's lots of, professional experience in this. But for this purpose, we've selected a range of 5 to 6 times based on these multiples. So we've taken 5 to 6 times, we've applied it to this current year's EBITDA of $5.6 million. And we come up with a valuation of about $28 million to $33 million in enterprise value. So again, really a lot of judgment, a lot of assumptions, but we're starting to get a sense for What is a sustainable level of earnings? And then also, what is a valuation multiple that's reasonable in this circumstance based on empirical evidence of the publicly traded companies that we were able to gather. I'm going to take a little breather here, maybe grab some water, ask if there's any questions. Okay, awesome. Okay, we do have a question here. So someone's saying that they're in a discussion with organizer of a music festival, willing to sell the festival. However, financial results and profits in the last 2 years were rather poor. What would you recommend as a basis for evaluation? Value of the brand, future prospect, or something else? Thank you. So again, I mean, value is based on cash flows, right? And usually sustainable future cash flows. So I would be looking to say, okay, the last 2 years were rather poor. What is next year going to look like? And provide evidence of why next year is going to be different than the prior 2 years. And then really understand that, okay, there's risk. There's a higher risk around achieving those last 2 years because the prior 2 years were poor, right? So why were the prior 2 years poor? Why were there challenges in the prior 2 years? What have you done to overcome those challenges to reduce the risk around being able to now value the business on this future cash flow? So that's what I would do. I would base the valuation on the future cash flow, provide a lot of evidence on why you're going to achieve that future cash flow, and then recognize that there's going to be skepticism on the part of the buyer, right? They're going to look at the prior 2 years and see those poor results. They're really going to question kind of like why you think you're going to hit those forecasts. So it creates difficulty around trying to sell the value, the business at a much higher valuation. But that's what I would do. I'd focus on the next year. And another thing you could do is just wait a year, right? Wait for that next year to actually materialize, to have it in the books. So now you could start basing things and valuation on actual results rather than these poor 2 years or based on a forecast. So, that's another realistic option, is to just wait and execute on a forecast to get a higher valuation. Hope that answers your question there. Okay, I have another question here on valuations. Would you take the median or average valuation, average multiple, discarding the high and lowest to remove skews? Thank you. I would take the average. I would try to, you definitely need to look at these with a critical eye. Again, as I had said, the global very, very large valuation multiples, the 11 times, the 12 times, the 19 times, like these are global 15, $20 billion companies, right? So are they truly comparable? So you might have to remove those or recognize that you're on the lower end. So you want to find if there's one target that's really close, there's this one company that's $500 million of market cap, 800,000, they're trading on the lower end. Maybe there's something happening within that business that makes it an outlier that you should remove. So I think you should, dig into the data rather than just grabbing an average. You should dig into the data. You should really, with a critical eye, say, okay, why are the big ones not as comparable? And then you should also look at some of them that are maybe on the low end and say why, what's happening within that business specifically that's giving it a low valuation. And then from there, once you remove the high or the low, then maybe I would take an average of the remaining. Also I think there's a real, especially for a business like this, to take a discount, right? So again, if we were looking at the average of this would probably be, call it 7 or 8 times. And I've selected a 5 or 6 because I'm discounting for the fact that, again, our business is much smaller. There's volatility in the earning levels, right? So this is where judgment comes in. And this is where you definitely need to speak to valuation experts, valuation professionals, people that have done transactions in this space. But taking into consideration all of those things is important. Okay, let's get back into the valuation, let's get into the presentation here. So again, I said we were going deep. I hope this isn't too deep, and I hope people aren't are finding value in this and really kind of getting a deeper understanding. Just kind of below just the surface level that most people stay on when they're talking about business value. Okay, let's talk about shareholder equity. So this is a really, really important area to discuss when we're talking about business valuations, because some people will do what we just did. They'll take the EBITDA and they'll apply it to a multiple, and they'll come up with enterprise value, what's called enterprise value. So that's the value of the whole business. But in a lot of cases, in mid-market businesses, it's more important to know what the value is for individual shareholders in the business. So enterprise value, which again, we just determined, is the value of the entire business. If we're thinking, and I like to use the analogy of a house. If we're thinking of a house, it's the value of the entire house. So let's just say, in this example, a house is worth $1 million. So that's what enterprise value, it's the value of the whole structure of the house. And then to get to shareholder equity, we have to add back what's called redundant assets. So it's assets in the business that aren't necessary for the continued operations of the business to earn that sustainable cash flow level that we talked about. So again, if we're looking at the analogy of a house, it would be the furniture in the house. Like you would sell the house for $1 million, but you'd sell the house, if it's including furniture, for the $1 million plus the value of the furniture, right? The furniture isn't needed for the structure of the house. The furniture is added onto the house. So that's the same thing with redundant assets. So it would be things like real estate. If you have real estate in the business, you wouldn't necessarily need real estate to run the business. If you had cash in the business, cash is not necessarily, excess cash is not needed to run the business. Cash in working capital is needed to run the business, but excess cash over and above what's needed in working capital is not needed. So you would pull that out and add that to the enterprise value. That would be over and above the enterprise value. And then of course, you're going to deduct debt. So just like in a house, we have $1 million house. It has a $200,000 mortgage on the house. So then the remaining equity value of the house is $800,000. So again, this is really important in determining, the shareholders' equity. We have to go through this calculation. We have to take enterprise value. We have to add back the redundant assets that aren't needed in operation. We have to deduct the debt. And then what's remaining is what's able to be allocated to the shareholders of the business. So this is a really important concept. Everybody get that? Okay, we got a question coming in here. See if it's related to this. Okay, so let's move on here. So in order to do some of these things, like determine the redundant assets in the business, we now have to look at the balance sheet that's being sold, right? So we've determined the enterprise value. We know that we're selling the business, and in this case, it was 27 to 36 million, I think the range was, right? But what are for that 27 to 36 million dollars? What are we selling? What balance sheet are we going to give to or deliver to a prospective buyer? So that's called the delivered balance sheet. We're going to get into this in a second on the schedules. This will make it all clear. So to do that, we would have to determine what assets or liabilities firstly need to be adjusted to fair market value. So in some cases, the book value of the assets on the balance sheet may have been, may not reflect what the current fair market value of those assets are. So we need to bump up those assets or reduce those assets to fair market value. The next thing we would have to do is we would have to determine if there are assets or liabilities that need to be removed from the business prior to closing. So that again would be things like excess cash would be a big one. Real estate is typically removed from a business if it's not needed in the business. And and a lot of times in middle market businesses and private businesses, I see personal items that are in businesses, so things maybe like a vehicle that's, it's the shareholder's vehicle, but it's been purchased by the business and it's not really needed in the business, so it can be removed. And there's other things. I'm sure you guys have seen clients, and you might be working in a business right now that has personal items on the balance sheet that could be removed prior to a sale. So we need to assess what those things are. And then another really big area that we need to think about is what amount of working capital is the right amount of working capital for the level of earnings that we say is sustainable within the business. And managing that working capital is important. Sometimes people don't manage working capital effectively, and maybe they'll have too much, and they'll be, they're carrying really high receivables and they pay all their payables really quick. So their working capital is very high. But if they were to be a little bit more efficient on managing working capital, it could be reduced lower. So, determining what the appropriate amount of working capital is going to be important, and anything over the appropriate amount can be removed from the businesses. Anything below the appropriate amount would have to be added back into the business. Okay, and now after we've done that in determining the balance sheet, now we can allocate those redundant assets. We can consider how much debt is in the business, and we can calculate the amount of shareholder equity in the business. Again, from enterprise value. Enterprise value plus redundant assets less debt would get us to the shareholder's equity. And once we determine the shareholder's equity, now we're allocating the shareholder's equity to various different components. So the first component would go to shareholder loan. Second component would go to any sort of pref shares. And then the third component would then go to common shares. So there's now, there's a hierarchy of, when we've determined how much shareholder equity is in the business, how does it get allocated? And it gets allocated in this preference, right? The first amount would go to the shareholder loans. The second amount would go to preferred shares, and the last amount would go to common shares, right? So, let's say there was a house that we're selling, again, that $1 million, there's $200,000 of debt, $800,000 of equity. But of that equity, you received, I don't know, $100,000 from your parents to buy the house initially. You first have to pay $100,000 to your parents for that initial loan that they gave you. And then the remainder would be, the equity that you'd be able to keep, right? So that's the shareholder equity within the business. Okay, we just went through a lot of stuff here. I want to make sure how much time we have left. Let's go through this in an example. Okay, here we go with an example here. Everybody can see this screen. Okay, so we've determined equity. Now we're going to look at the balance sheet, right? So the balance sheet here, pretty healthy balance sheet. Current assets, there's about $30 million of current assets. Again, they have land and building in the business. They have equipment, automotive, office equipment in the business. They have some bank indebtedness in the business, which, reflects kind of working capital. They have accounts payable, and then they have long-term debt. So they have about, let's say about $14 million of long-term debt. They have some shareholder loans, and then they have their retained earnings. So the first thing we're doing, as I mentioned, we're going to bump up any sort of amounts that are required to determine the fair market value of the land and building. They say that the land is worth, about $17 million here. So we bump up this book value of land and building to 17 million. Their equipment is worth 6 million. So we bump up their equipment to 6 million. And then, so this is the net adjusted value for their balance sheet after they've made adjustments for fair market value to land and to the equipment, right? So that's step one. Step two is now removing any sort of assets that are not required in the business or would not be included in the sale of a business. So again, remember in the normalizations where we normalized for rent, and somebody had asked this question previously. So this is where we were going to we're going to go over this. So we normalized for rent, right? There wasn't a rent charge in the business because they owned the land and building. But now when we're selling the business, we're not going to sell the land and building on the balance sheet. We're only selling the business with that pays that rent on a business that doesn't have the asset in it. So it's going to pay fair market value rent, but we're not going to double up on that and then also sell the land and building with the business, because now we have a charge for that rent in normalizing the EBITDA. Does everybody understand that? Sorry, that was a very convoluted way of explaining that. But again, because we have the fair market value of rent that we've considered in normalizing the EBITDA, we are removing the fair market value of the land and the building from the sale of the business. So here, when we're looking at what we're actually selling, we would sell a business that has working capital here. So all of your current assets, less your current liabilities, of about $12.5 million. And you would sell the equipment, automotive, and office that has a value of about $6.2 million. So your net tangible assets that you're selling for a business that we've determined has an enterprise value of 27 to 36 million, that value would include net assets without the land and building and without the debt of about $18 million. Does everybody get that? This is the balance sheet that you would sell to a prospective buyer for that value of 28 to 36. Okay, awesome. Now we're going to try to calculate. Sorry, I've been saying 36. It's about 33, 34, right? So now we're going to calculate the equity value, the shareholders' equity value. So we have this enterprise value. We add back the redundant assets, and we said the redundant assets are the land and the building. We add them back, right? Because you get to keep that. That's value that's still attributable to the shareholders. But we deducted the long-term debt, because anybody that's buying this business would expect to buy it with no debt in the business, right? So the net the total value of the shareholders' loans and shares is, again, $31 to $36 million. We take the enterprise value, we add back the redundant assets, and we deduct the long-term debt to get your shareholders' value. Now, what we need to do is allocate that shareholders' value to the different shareholders, right? So we said that there were shareholder loans on the balance sheet. We go back here, we see shareholder loans of $4.5 million, right? So we need to say that of that equity value, and somebody had asked this question to go over the equal parts again, of that equity value of 31 million to 36 million, 4.5 million is going to be allocated to pay back those shareholder loans, money that the shareholders had initially put in. And then after that, there are no preferred shares in this example, but after that, we are now allocating it to the proportionate share ownership that each shareholder has. So in this example, there are 5 shareholders. They have differing share ownerships. So one shareholder owns 51%, one owns 25%, one owns 12.5%, etc. And we can see that the allocation of the remaining value of the shareholder equity is allocated proportionate to the share ownership percentages. Everybody understand that? So you can see that the total shareholder value is equal to the total value that's paid out. It's two sides of the equation, right? So you have the value of the equity, and then how is that allocated? It's allocated to the shareholder loans, then to the prefs. Again, in this example, there are no preferred shares. and then allocated proportionately to the shareholders. And you can see how important this calculation is, right? Like if this debt was $25 million. Well, okay, that's too big. Let's say $20 million. You can see how the value that the shareholders are pulling out is significantly different, right? And this is really what most shareholders care about. They care about how much share value that they're going to extract from the business when they sell it, right? So the enterprise value is important, but the equity value I find for the individual shareholder is much more important. And I oftentimes see that this is a step that's missed. People will easily do this, right? They'll determine, okay, my EBITDA is 5 million. I've heard from people that enterprise, multiples are, 4 to 5, 6 times. That's easy math, right? But then getting to the value of the shareholder's equity is an extremely important step, right? You could, how would you feel if you were shareholder number 5 with 4%, right? And, from $1 million to $1.2 million, versus again, if the debt was 20 million, he's only getting $800,000. So that's a significant amount of difference that's kind of being considered or needs to be contemplated for each individual shareholder. I have a question here. I'm not sure that I'm understanding it. So if you want to just articulate a little bit more, why do we have the sections grouped into high to low? I'm not sure what sections we're referring to, but oh, sorry. Okay, the valuation sections, right? I mean, this is giving a range. There's a lot of judgment in terms of what valuation is, right? So you don't go in and say, just like the value of a house, right? You say, well, I think it's $1 million, but when we go to market, I might get offers anywhere from 800,000 to $1 million, right? So that's why we do a range of high to low, because you can't, when you're doing this in a notional setting, or you're just doing it for planning, you can't really kind of just pin it down and say, hey, the valuation is $29 million. We like to have high to low just because it's the market would come in with different offers that might be, some might be at 5 times, some might be at 6 times. So we like just to consider a range of what's reasonable in contemplating all of this. But you're right. I mean, let's say we were to sell a company, we're going out to market, and we received a really hard offer, and it was $29 million. Then, we would go through this machination and we would determine, okay, at $29 million, what does that imply for, the value and what's being allocated to each individual shareholder? Okay, we're coming up in our last topic here. And I think it's a very, very, very important one that, again, doesn't get enough love and doesn't get enough attention here. So the last topic is goodwill. And goodwill is a pretty simple calculation. It's the enterprise value, and we've already talked about this. I haven't highlighted it specifically, but we did go through this calculation where it's the enterprise value, again, 27 million to about that $34 million, less the net tangible asset value that we determined, and I think it was around 18 million. That's going to give us goodwill, right? So let me just show that real quick here. So I just have that calculation here below. We have the tangible net operating assets of 18 million. We have the enterprise value of 28 million to 33 million. So the difference between those two is goodwill, right? It's intangible. It's something that is, you can't feel it. That's exactly what a goodwill is. It's something that's not hard, like this desk. Or this glass. You can't feel it, you can't touch it. It's so anything over and above the tangible assets getting up to the enterprise value is goodwill. So what constitutes goodwill, And I have a slide here for that, just so we can put a little bit more tangibleness around it. So, and I think it's important, once we've calculated goodwill, to recognize that that's a big number, right? So we're selling a business for $27 million. Let me just go back to this calculation here. We're selling a business for $27 million, and we have $10 million to $15 million of something that's intangible, right? Any buyer is going to question that. They're going to really want to know, what am I paying for? With the 18 million, I know that I'm paying for a certain amount of working capital. I'm paying for a certain amount of equipment. But for this $9 to $15 million, what is it in the business that constitutes me paying that much money for a business, right? And these are large amounts of money. Like, you can see that close to 50% of the value of this business, we're saying, is the goodwill. It's something that's, you can't throw your arms around, you can't feel, you can't touch, you can't get independently valued or appraised, right? So what is this amount, right? So articulating goodwill is a very, very, very important exercise. And here I have, this isn't an exhaustive list of things that might make up goodwill, but it's a starting list of things to consider when you're looking at goodwill, right? So we have suppliers agreements could form part of goodwill. Niche product that you have, advertising material, thought leadership, your website, domain names, could make up goodwill. Trade secrets, licenses, customer relationships, your systems and procedures. All of these things can make up goodwill. And I think the important job of, not only the investment banker when they're going to market with a business, but the company itself, after you've determined your valuation, you've determined enterprise value, you've determined, what a delivered balance sheet looks like, and then you're able to do this calculation of the quantum of goodwill. It's important to start saying, okay, what actually makes up that goodwill, and how can I articulate it? How can I really qualify, why our business deserves to get, $10 to $15 million of value for this, intangible part of the value of our business. Okay, any questions on this? Okay, I just showed you the example of calculating goodwill. And again, the calculation is really simple. It's the enterprise value less the tangible assets that will be delivered when you're selling a business. But the articulation and the qualification of what goodwill is, that's where the importance of this kind of exercise really comes into play. Okay, guys, we are almost up on the hour, but we do have time for some final questions if you have any. Okay, anyone have any last questions here? Okay, everybody, I hope this has been of value. If you want to dig into this deeper, you can reach me on LinkedIn, just DM me. Again, we're happy to help with any sort of valuation or M&A advisory work that you need. I have found that this initial exercise of determining value is so important. And doing it well before you're even contemplating any sort of transaction this is probably the most important thing that you can do, in the planning phase, in the, kind of journey of trying to transition a business, or on the flip side, if you're looking to acquire a business. Obviously, determining the value is, a really good starting point. So thank you, everybody, again. I really appreciate you joining me. And again, DM me if you have any more specific questions or you need any help with anything. Have a great day, everyone.